Good afternoon. Welcome to Restart Michigan with Lockton, evaluating business interruption protection amid COVID-19. My name is Tabitha Mensch, and I am an engagement manager with the Detroit Regional Chamber and Mish Auto. Thank you for joining this session. The Chamber launched a series of webinars to help businesses across the state prepare to restart operations and return to work. I would like to thank our guest speakers from Lockton for volunteering their time to share their expertise. Before we get started, I wanted to make you all aware that participants are muted, but you do have the option to submit questions through the GoToWebinar control panel. Our speakers will try to address as many questions as time will allow. I will now turn the webinar over to Quinn from Lockton.
Thank you, Tabitha. Welcome, everybody. Obviously, I wish we were giving this presentation in person. This will be our first virtual presentation like this, so we'll do our best. Hopefully the product is to your liking. I think a good place to start will be kind of an overview of how we're going to spend the time today with the table of contents. So when looking at this, I think a good place to start is with a general overview of business interruption coverage itself, right? What is it intended to cover? What do traditional policy forms have in writing as it pertains to situations like COVID? How do you calculate a claim? And why are we in the situation we are, with relation to claims being denied or potentially being, litigated at this time. We're then going to look at current litigation developments of open case law that we've been monitoring, as well as some cases that have come to fruition. And then lastly, I think the most important question of, what lies ahead. We've now seen this happen once before. How is this going to be protected against in the future? What are new evolutions? How is the insurance industry responding? How is the government responding? So on and so forth. So those will be the three buckets we tackle today. But I think to start with, we'll do introductions for myself and our team. So Lockton Companies, we're new to Detroit physically as of about a year ago, although we've done business with companies based in Michigan for years. We're globally headquartered out of Kansas City, but again, opened up here locally in Birmingham and Detroit, and just recently Grand Rapids this year. We're the largest family-owned insurance brokerage and risk management firm in the world. So with me today is Sherry Wilson out of Dallas, who's the National Director of our claims practice. Sherry, I'll let you give a brief introduction.
Yeah, sure. Thanks a lot, Quinn. I appreciate that handoff, and I appreciate your time and opportunity to speak with you today about sort of what's happening in the COVID space and with regard to business interruption and the impact to just the economy generally. I'm National Claims Director, as Quinn said, for Lockton. I handle all of the large not all, but troublesome first-party claims for all of the Lockton clients worldwide, mostly in the U.S. And I've been doing property and first-party claims for 30 years. So it's been a fun thing. It's something I never thought I'd be interested in, but somehow I've gotten interested in it and love to talk about it. So it should be fun today.
Awesome. Thank you, Sherry. Nate?
Yeah. Hello, everybody. Nate Wiest, unit leader for property and casualty with Lockton in Michigan. 14 years of experience combined on the underwriting side and the brokerage side. My role is I lead the service team that works with Lockton property and casualty clients here in Michigan. Thanks for having us.
Thank you, Nate. And I'm Quinn Damon, producer partner here in the Detroit office as well. So with that, I think we'll get started. So looking at business interruption to start with, the coverage in general, right? So what is business interruption coverage? Everyone is familiar with property insurance, whether it's your commercial policy for your business or your homeowner's policy, right? Fire, lightning, windstorm, hail. Everyone understands the idea of property damage to your building or home and having insurance pay for those claims. The business interruption component of commercial insurance covers the reduction of income when an operation is interrupted due to property damage by a covered peril, which is important to the aspect of that peril being covered, which we'll touch on later in relation to COVID. So when looking at, go to the next slide, Nate. When looking at a property claim in general, typically an adjuster in a situation, we're going to follow what we call the chain rule. And it's basically, following a line of questions in an event to find, is there coverage or is there not coverage available? So if you're looking at these steps from, an elementary angle, right, the event of physical loss of damage, did something happen? Was there a fire? Was there a hailstorm? Was there something that there was a physical event? The next question they would ask is, was this an insured location? When looking at the policy, was this address listed as an insured building that has, incurred the damage? The next two are highlighted because they're what we'll touch on as it relates to COVID-specific claims we've been seeing. So the next one is from an insured peril or event of physical loss or damage. So when we talk about insured perils, that could mean, well, was the damage caused by flood? If so, did the insured purchase flood coverage or is flood excluded? Or was it fire, lightning, windstorm, hail, different perils that are either covered or excluded by the policy forms? And the next one is, were there no specific policy exclusions? So in that case, outside of the core coverage form, are there any exclusions added to the policy that would restrict coverage from applying in this instance? If, as an insured, you have what you would hope are the right answers to those four questions, you would meet with the insurance company representative, measure the amount of the loss, and receive payment. So again, that's kind of an overview of what we would call the chain rule. So going back to the first highlighted item there, as far as physical loss or damage being the trigger. So I won't read it, but this italicized paragraph here, we've pulled directly from the ISO, which is basically, an insurance services organization that helps build core policy forms that a lot of carriers adopt the policy language. And this is essentially a paragraph from the business income coverage talking about what we will cover in the event of a suspension of your operations. You'll notice a line we've highlighted there that says the suspension itself must be caused by a direct physical loss of or damage to property. So when we're talking about COVID claims, if there was no actual property damage present, that's where insurance carriers have declined claims because they're pointing to this policy language saying, yes, there was a suspension of your operations due to, government shutdowns or what have you. However, there is no direct physical loss that created that suspension. So that's the initial stand that insurance carriers have been taking in any sort of business interruption claim. Now, I will add, and you'll see at the bottom, there are also additional coverages in place for civil authority, ingress, egress, where maybe the government does say you can't access your building. However, to give you an idea of an example of the intent of the policy language is that it still has to come from direct physical loss or property damage. So for instance, if you had, a donut shop in a strip mall and a tree fell down on your neighbor's store and they had to shut down access to the entire strip mall for a week and you couldn't conduct business, you can make a claim under civil authority there because you were told that you can no longer operate your building. And the key is that it was tied back to physical loss of or damage to property. So that's the key component there in the language here that, again, when you're talking about the presence of a virus or the government shutting down your operation because of the presence of the virus, the carriers are standing on the hill that there is no actual property damage or physical loss. The next one we highlighted was, are there any exclusions that apply? So typically in a property policy, you might find in a pollution exclusion that they can try to draw it out where they'll find that the actual virus itself or bacteria is a pollutant. And that's where they may pull coverage to exclude from there, citing the pollution exclusion. But one that we probably saw more often than not is what we say it's a virus exclusion, but the term we saw a lot was a communicable disease exclusion. And basically that exclusion, if it was on a property policy, negates the debate on the prior page of was there direct physical loss or not, because it essentially gives them the out that if there's any claim for damages due to a communicable disease, it's entirely excluded, no questions asked. Now, doing research for today, we found this interesting that when this policy form in 2006 was introduced, and that's the communicable disease exclusion, was introduced by ISO. The reason that they wanted the form to be added and what they said to state insurance commissions was the following, that we want to introduce this endorsement out of concern that in the event of a pandemic, there could be efforts to expand coverage and create sources of recovery, despite the requirement of actual property damage and the exclusion of loss from contamination within the pollution exclusion. So this was 14 years ago that this form was invented, and if you read the language of why they invented it, it was exactly for what we're experiencing today with coronavirus. And back in that time, SARS is what predicated a lot of the need or want of the carriers to develop this form. So like I said, we found that very interesting. That's exactly what they predicted may be the case, and that's what we're seeing today as far as virus exclusions go. Nate, I think you'll take it from here.
Yeah, great. Thanks, Quinn. I'll pause there just for 1 second. Sherry, any questions coming through that we needed to address?
No, not yet. I'm watching the questions.
Great, thank you. So we thought it made sense as we're going through this to level set and talk about how a business interruption claim is adjusted or looked at. So from a high level, business interruption or business income is calculated as gross earnings minus non-continuing expenses, or net income plus continuing expenses. As I'm sure you guys know, gross earnings, that is the difference between revenues and cost of goods sold. Another key component to adjusting a business income loss or claim is this idea of period of restoration. The period of restoration is simply the time required to restore normal level of operations for the affected business. Another key term there is continuing expenses. Continuing expenses are going to be things such as payroll, rent, taxes, professional fees, heat, light expenses. So those are the things when we contemplate either non-continuing or continuing expenses in the adjustment of the claim. A couple more pieces here that we thought were important to hit on. Hiring a forensic accountant is recommended in most business income losses, including COVID-related losses. But a very important point to note is most property policies will provide reimbursement for the expenses of a forensic accountant to come in and look at the books and audit the books to see what the true loss was and quantify that for you. But that reimbursement of that expense for a forensic accountant it's very important to note, would only be reimbursed if the claim is paid. And so again, we come back to some muddy waters and a lot of questions around COVID. So if you want to engage that forensic accountant in looking at your business interruption loss related to COVID, it's important to contemplate that the cost of that forensic accountant bringing that individual in would only be reimbursed within the policy if the claim is paid. And then just as a general rule, the carrier is going to look back going up to 2 years in a business interruption loss or claim. As you're recording losses for COVID, it's important to pay attention to any increased costs related to the pandemic. Examples there would be finance charges, increased material costs, all in addition to the loss of income for your business if it's forced to be shut down. Very important to document the date when the order to shut down went into effect from a governmental level. And you want to make specific notes of how your company responded once that government directive came down. Keep record for reference down the line. It's important to keep detailed notes. If anybody on the presentation today is anything like me, it's much easier to make notes now and refer to later versus going down the line a little bit and having to look back and remember exactly what happened. So don't rely on memory there after the fact. Highly encouraged to give a detailed documentation and notes as it's happening. Establishing a separate and distinct account number for recording all expenses unique to COVID, very important recommendation there. We recommend to record these costs in a general ledger account that you can refer to and can be audited to be included in the claim. So the key is there, keeping those expenses separate from normal operating expenses for your business to make sure the documentation is clear in the effect that COVID had during the shutdown. We just provided a couple bullet points of some examples by industry of things to keep record of, any differences. Good to keep a checklist, just handy to refer to as you're keeping record of the additional costs and loss of revenue during this time. So now we wanted to shift into what's going on at a court level as far as the litigation developments. Quite frankly, most courts have provided a summary judgment, meaning there's no trial. They just look at the facts of the case presented by both parties. And quite frankly, they've said at this stage, they do not want to move forward to trial with these cases. And again, they're making a summary judgment at the court level at the judge's seat. A few courts have ruled that insureds can sue the carrier, but this does not mean that there will be a victory in that suit. It simply means that the case can be heard. On the screen, hopefully you can see these boxes. This is just a very elementary view of how this works. Claim filed with the insurance company, obviously looking for business interruption coverage within the property policy for your loss during the time of the governmental shutdown. As we're seeing right now, these claims are being denied based on policy language. So then you come to a point where you say, okay, is it worth it to file a claim or file a complaint in court? And it's important to look at a thorough review of the policy language to see if there's any gray area there that you think or your legal team thinks that there may be an opportunity to have this complaint heard and ruled in your favor. And really this comes down to the decision, is there going to be coverage and what would that coverage mean to you and as far as dollars, and weighing that versus legal fees, because you know, obviously the lawyers are very much involved in this, looking for gray areas and loopholes and ways to push this and find a favorable ruling in favor of insureds. But obviously there are going to be legal fees associated. So very frankly, if you're do a review of that policy, and if your policy is going to pay out say a couple $100,000 under a give back of coverage, you want to weigh that out versus what the legal fees could be and what the net effect to your business would be. I thought it was important to highlight a Michigan case as an example of really what the court's perspective are on these complaints that are being filed. One of the first summary judgments on COVID anywhere in the United States happened here in Michigan. This was a owner of 2 restaurants based here in Michigan was forced to close these 2 restaurants as a result of the governmental orders in Michigan. The insurance company used the argument of direct physical damage that we talked about earlier. They clearly said that the direct physical damage trigger needed to be there in order to trigger coverage, arguing that the restaurant did not physically change following the governmental orders. And this is really where it sticks right now as far as litigation. In this specific case in Michigan, the insurance company cited a previous case from 2010 with a restaurant where mold in the restaurant caused a foul odor. And as a result of that foul odor, the owners decided to close the doors until they could get it cleaned up and get rid of the smell. The court ruled in that case that the property did not sustain physical damage, and therefore there was no business interruption under the property form. So again, in this Michigan case, that was one of the first summary judgments on COVID-related complaints. They cited this case from 2010 where the court ruled that even though this mold was there and there was a smell, the physical aspects of that restaurant did not change. Again, going back to the 2010 case that they cited in use of the complaint, that was one of the first here in Michigan related to COVID. And that's really a good indication of where the litigation developments stand right now. And almost just as an aside, or almost to pile on a little bit, the insurance company in this specific case here in Michigan submitted that even if the physical damage trigger was there in this case, the virus exclusion in the policy would have prevented coverage. So again, it really comes down to those 2 things we were talking about earlier: physical damage trigger and any exclusion specific to viruses or pollution. And that's really where this litigation debate sits right now. Okay, so I'm sure you guys have heard a lot of these things about why these claims are not being paid, the litigation that's not going in favor of the insured. So we wanted to look at a couple things that we see from a legislative perspective and also in the private insurance market, and give an overview of those. So legislation developments. The Financial Services Committee in the House had a roundtable hearing in September to look at options for this. Some of the things we'll talk about were the result of those roundtable meetings. The Senate Banking Committee is looking to insurers, policyholders, insurance brokers to come together on a solution. To give you an idea, the two huge sticking points here are cost and ease of administration. I think the cost is fairly obvious. This is going to be a big number, so that is a hurdle, obviously. But ease of administration, to give you an idea, there's a lot of comparisons to what the legislation is looking at to the Terrorism Risk Insurance Act, also referred to as TRIA, T-R-I-A. Some of you guys may, when you renew your commercial insurance policies, you may have a form that you sign where you either accept or reject the Terrorism Risk Insurance Act. To give you an idea, that TRIA took about 14 months of wrangling with the insurer and policyholder community. And right now, looking at that as a model for a solution, the questions are, basically, is a solution necessary? How likely is another pandemic to happen? And can we just do an ad hoc approach like reinstating the payroll protection plan, which became a lot smoother to administer once they got the kinks worked out. But an important point to note here is that really the early conversations when these first complaints and claims were being filed by insureds throughout the country were that everybody was aggressively looking for payment retroactively to cover losses that had happened. Talking with our legislative group that watches this stuff very closely, they have said very frankly, any efforts to go back and retroactively pay COVID losses at this point, despite contract language that would be to the contrary, that train has pretty much left the station. Everybody involved has pretty much agreed that if there was contract language with the physical damage triggers or an exclusionary language within the policy, not many folks are focusing on that anymore. They're looking forward to legislative developments that could solve these issues going forward. So some of the legislative options that are on the table. I'm sure you've heard of PRIA, or the Pandemic Risk Insurance Act. These are some of the proposals that have gained the most traction. PRIA is modeled after TRIA, the Terrorism Risk Insurance Act that we talked about, but there are two fundamental differences. TRIA was necessary because policies provided for coverage, but the industry didn't reserve for terrorism. So essentially, property policies did not exclude terrorism. They were silent on terrorism, so then in effect there would be coverage. But they just didn't have the money set aside for an event like 9/11, which really kicked this into high gear. Terrorism attacks also comply more closely with the general rule of insurance that the large losses of a few policyholders are in essence paid by the many, or all the other policyholders out there. The big difference here is that with a pandemic, really the model is the many losses are paid by the many. It's just one of these events that insurance just wasn't ready for, quite frankly, because everybody across the spectrum is going to be affected by this in some way, shape, or form. That is really tough to put an insurance mechanism in place when everybody is experiencing the same losses or the same claims. Another legislative option that is gaining traction is the Business Continuity Protection Plan, or BCPP. This is probably the closest you could think of as flood insurance. Right now, the federal government offers a national flood program that you can buy into. Some of you may have seen that or participated in it. But the facts are that many folks in Congress, they don't like the flood program because, quite frankly, it consistently requires more funds, and they believe FEMA's doing a poor job of managing it. So that's kind of some of the push and pull going on right now. This Business Continuity Protection Plan would allow businesses to purchase a policy for up to 80% of the payroll benefits and some other limited expenses for 3 months. The The federal government would make the payment out on these based on an emergency declaration, and then they would look to audit the claims after the fact, and it would be administered by FEMA. And then just real quick, hitting on the PREA, or the Pandemic Risk Assurance Act. You know, the way that's set up right now is that once aggregate losses, so once total losses from a pandemic would hit 250 million, the federal government would step in, paying up to 95% of the claims resulting from that pandemic, with the insurance carrier community paying in 5% of the total cost based on their earned written premiums in the previous calendar year. And then that aggregate amount shared between the federal government and the insurance carrier community from 250 million would go up to an aggregate amount of 750 billion under that Pandemic Risk Insurance Act. Looking at some other federal legislative options or proposals that are on the table, the Pandemic Business Interruption Program. This is similar to the BCPP we talked about on the previous page. Similar carriers and federal government would share in this risk up to $250 billion in losses. And then the federal government would cover any additional losses up to an additional 500 billion. Sorry about that, folks. Going on to the next one here. Oops, sorry, I think I skipped over one maybe.
Hey, Nate, we're getting kind of close to time, and this is Sherry. Just real quick, no questions, but I just wanted to let you know.
Okay, thank you very much. Appreciate that. Okay, sorry folks, lost my spot a little bit here. So these, the big difference here between this pandemic, well, essentially these are the favored options right now: the Pandemic Business Interruption Program, and then a larger program for this Pandemic Re-program. Why these are favored right now is that it's not a one-size-fits-all, and it's a true private-public partnership. This Pandemic Business Interruption Program would be for employers up to 500 employees, and then larger companies above 500 employees would then have the option to opt into this Pandemic Re program for up to $50 million of coverage for pandemics. The thought there is that some of these larger companies are able to self-insure or pay from their cash flow or out of their pocket for these expenses, where some small businesses with 500 or less employees would not have that ability. So that's one of the advantages of this program as it's put out under legislation. From a state perspective, to date, only Washington, D.C. has enacted legislation on a state level. That legislation simply just extended the time period when insureds were able to submit a claim for business income losses. There's a lot of yep.
I'll say, do you want to jump ahead to since we're running short on time, do you want to jump ahead to the private market solutions, and I'll run through those real quick, and then we'll open it up to Q&A.
You got it.
So again, this again going to coincide obviously with government interaction. The insurance community is trying to come up with some innovative approaches to this in the future, and a couple that are available today. One is called PREP, Payroll and Rent Expense Protection for Pandemics. Again, like anything, as you can guess, right now the premium is expensive and the terms and conditions are slim, but any step towards innovation will encourage others to step forward. So in the PREP program, you're looking at about a 6-month policy term with limits ranging from 500,000 to 1.5 million. There are state restrictions within that, and the trigger itself would be a pandemic declaration by the CDC. So premiums for that, you're looking at roughly a minimum of 250 grand plus just for $1 million of coverage. So again, not going to be the most cost efficient model today, but at least if someone starts first, over time, hopefully capitalism will drive some of that down. It's also one to note that there have been pandemic policies offered in the past, specifically Munich Re, These have typically been taken out for large events. For instance, Wimbledon has purchased this policy for the last 20 years or so, and they finally collected this year. A few events did on Munich Re, and as you can guess, Munich Re is now exiting that space. So they had their run of collecting premium. Now they've paid out a big check, and they're now stopping the offering of that policy in the meantime. We're also seeing some new innovations around business income. This is not COVID related, but it's a new way of looking at business income. Lloyd's of London is rolling out a new program called Parametrics with an X insurance, and it's essentially a business interruption policy for small to medium businesses that are centered around IT disruption or downtimes. So that one is unique because it's allowing business interruption specifically unrelated to property damage itself. So again, we may see more innovation like this in the future, building different triggers around business interruption payment to make it easier for Main Street to purchase these kind of coverages. So talk to your broker. You'll probably see more of this coming out on a quarter by quarter basis as, look, if there's ever an opportunity to develop new products and it can be profitable, rest assured the insurance community will find a way to deliver it. So I think with that, Nate, I think now it's just Q&A.
Yep.
Perfect.
So far, it's a quiet group.
I'm shocked. Insurance is so exciting.
So let me, this is Sherry, let me just sort of talk through a recent matter that I've had with one of our Lockton clients on the COVID claim. The call was obviously, do we have any coverage for business interruption? We've been closed because of shelter in place orders, and this affected our business worldwide. The question is really always, you have to look at the words in the policy. You have to look at the words in your lease agreements that say what allows you to not pay the lease or pay the lease. Every contract that you've entered into under your business really needs to be reviewed for wording and see where, if anything, we can look for things that might trigger the coverage. So as the broker and as your advocate as a broker, we always try to look for where the coverage is, not where the coverage isn't, but at the same time set client expectations with regard to, this is probably not going to be a positive response in your favor, but we are going to still fight for it. So if there's any questions along that line ever, feel free to give Nate or Quinn or myself a call anytime, and we can talk through that with you. I know we tried to hit on a lot of points today, so just feel free to reach out if there's anything that you have questions about or something that just doesn't make sense.
Thank you, Sherry. I think if there are any questions, Tabitha, I think we can turn it over unless, Sherry, if any questions are popping up, but I understand if there's not.
No questions so far.
Okay.
Excellent. Well, thank you very much. Again, this is Tabitha, the Chamber, to wrap up today's discussion. Thank you to the team from Lockton for providing this expertise and sharing your time with us. To all the participants, thank you for your time today. You will soon receive an email from me with a link to today's discussion in case you want to review any of the information shared. Please visit our website at detroitchamber.com/COVID-19 for the upcoming schedule for Restart Michigan webinars, as well as our teletown halls, and for more valuable information and data to help your business return to work. I hope everyone has a wonderful afternoon. Thank you.